Hey guys, I'm the Newb investor. I feel like I've been looking heavy at tech stocks the past couple weeks, so I decided to look at another sector, consumer defensive. In this video, we'll look at PG at purely financial standpoint. We'll be screening PG through our three metrics to see whether the stock is trading at overvalued, fair, or discount prices. And from there, we should see if the stock is a buy or not. PG is currently trading at $158.24 with high price of $165.35, market cap of $379.31 billion, and PE ratio of 27.97. It gives out an annual dividend of $3.48 a share, a yield of 2.2% of the current price. PG is one of those must-own stocks because their products are at the core of each household. But if you're buying PG for the dividends, let's check their payout ratio. With EPS trailing 12 months of 5.66, their payout ratio is 61%. Is it dividend safe? I think so, yes. We want it lower than 60%. It's over 60, but it's pretty much in the same area. Let's go to our metrics. First metric, we want an EPS multiple lower than 3. It's 4.94. Does it mean it's not a buy? No. We have to remember this sector is like the hottest sector for buyers. It's like tech. No one is really selling these kinds of stocks. They buy it and hold it for long periods of time. Because as consumers, we think these companies will be around for as long as we live. But we also don't want to pay for an overpriced stock. Next metric, we want to pay $1 or less for 1% of their net income yield or free cash flow yield, whichever is lower. Or in other words, we want to pay $1 or less for the 1% of the money they're making. We'll take the current year's yields and the averages of 5 and 10 years. The more data, the better. In this video, we'll only be using 5 years of data just to show you our process. I've also included the costs the company uses to continue their operations like COGS and OE, operating expenses, just to kind of have an idea how much they use and how high or low can they manage to juggle these expenses. Of the 4 highlighted values, we'll take the lowest yield to get a baseline for our assumptions. In this case, it's 16.21. We'll use it to divide the current PE of 27.97 and we'd get our discount of 1.73. If we're buying at these PEs, we'd be overpaying for the stock. Next metric is historical PE. We want to know our discount compared to how the markets valued the stock before. I took the data from a site. I'll put it in the description box below. Take the average PE to divide the current PE and we'd get a discount of 1.23. Compared to the PEs before, the markets are overvaluing the stock now. In conclusion, PG did not pass any of our metrics. Doesn't mean it's not a buy, but maybe we need to kind of have to integrate some multiples or just adjust our PE by how much the markets are valuing these companies. My entry PEs are 18, 20, 22. These are ranged between the historical PE and their yields. By the current EPS, the target entry price is around $125. This will be a good price to open a small position for the stock. If you like to invest in these companies, I'd advise you to use a longer time frame of data, like 10 years of data or more. Also, look at their other metrics like long-term debt, current ratio, etc. As always, do your own research.